I always say this out loud to people that, you are playing with someone's future when you're making some of these decisions. And so you need to think about it logically about whether would you do it for yourself. And if the answer is no, you should never do it for a client. And so it comes down to the ethics, but it also comes down to experience that you bring on the table too. So a lot of people have always seen the good side and they've never seen the bad side of property. And so, post-COVID, you've seen these massive booms where properties have grown by 30, 50, 60%. And so they think that, this is the direction that the property always goes, right? So when the interest rates started rising, you would see, I saw a lot of, noise basically cutting out as well, because people panicked and they realized who is the real deal and who are the people who were basically, coming out because there was no more rain and, sun was shining now. So yeah, I do strongly believe that there needs to be some sort of regulation around it.
Co-living properties can generate almost $140,000 in passive income and net of $40,000 in passive income after mortgage repayments, and they sit in an average yield of about 10%. Hello and welcome to another episode of Help Me Buy Property podcast. Today's guest is a financial advisor, and believe it or not, he's one of the good ones. James Gerard from Financial Advisors. We're going to talk about financial advice, not real financial advice, but property advisors and financial advisors in the property investing space. We're also going to talk about the general market trends, what is happening with US elections, interest rates, all the gimmicky stuff that is happening out there in the world of property and in the world of macro environment. Let's give our co-host a warm welcome. James, how are you today?
I'm doing great. Thanks for having me on.
Thank you for coming on the show. Talk to us about yourself first. I love your the cool financial advisor domain that you have. That's pretty awesome.
Yeah, so that was back from maybe like 15 years ago when I was working out in the suburbs northwest of Sydney, and I thought, how's anyone ever going to find me? Like, I'm out here in the middle of the bush, and then internet was starting to become a thing. And so I found the domain name financialadvisor.com.au and lucky enough to buy it. And it's been great because there's been a big emphasis on digital marketing and people looking for services online. So that's served us well. So from that starting point of buying the domain name, I set up the business. And then about 7 years ago, we became self-licensed from the government, which means that we don't have any conflicts of interest. And that's a really big thing in financial planning. A lot of financial planners are licensed by a big bank or a big financial institution, and they're almost like beholden to that master, where they're very restricted in terms of what they can do. And
Yes.
we'll start to drill down into that, I guess, a little bit later with regards to how that affects the outcomes for consumers. But for us, being self-licensed has been fantastic because we can talk to our clients about properties, shares, private equity, crypto, whatever we think is appropriate for them.
Yeah.
We're open to having a chat about it.
And I think that's great. I think that's a good segue for viewers and listeners. Let's talk about who is actually a financial advisor. Because as I said, there's a lot of taboo, there's a lot of stereotype. When you come into the property world, they are the villains and the dons in the property investing space. So let's help people. And as I said, I truly believe the value that you provide. So let's, for you viewers and listeners, help them understand what is a true financial advisor and what role do they play?
Yeah, so a great question. A financial advisor is basically like a project manager for you as an individual. They'll help you map out the future and then they'll help you implement things. So that could be to help you refinance a mortgage in conjunction with a mortgage broker. You could lay out a plan to buy properties. So for example, I've had a client where he was 50 and he said, James, I want to retire when I'm 60. I want to buy one property every year until I'm 60. And then when I'm 60, we'll sell 3 and then I'll have 7 properties with no debt. And so we modeled it from a cash flow perspective, looked at the tax outcomes. We had a look at interest rates. We had a look at the characteristics of the property. So do we need to go for growth properties or income properties to keep buying year after year? Because the more you buy, the bigger the loan is, the harder it is to get that next loan from the bank. So as a financial advisor, we're looking after everything with an individual person to basically help them make good decisions. And that also includes some of the boring areas, but they're important, like insurances and then tax structures as well. We consider superannuation versus investing in personal name. If it's personal name, is it the higher income spouse, the lower income? Do we use a family trust, company?
Yeah.
So there's so much things that we can get into for people at different stages of life. So whether it's someone who's graduated from university and just starting to get into the workforce and generate some income, all the way through to people who are retired, financial advisors, good financial advisors can really help pretty much anyone.
And so why do people think that financial advisors cannot basically advise on property?
Because they generally don't. Not many of them do. And to get to the core of it, you really have to understand how financial advisors charge and how they make money and run their businesses. The majority of financial advisors, you come into their office and you talk about your goals and aspirations. You want to buy a house, pay it off, a couple of investment properties, bit of shares, maybe have kids, those type of things, travel, be financially independent. And they're going, yep, they're writing it down, but really they're just thinking, which managed funds can I stick this person into? Can I get some life insurances for them? So there's a conflict between what a general person will want with their wealth accumulation goals and what the financial advisor or financial planner can offer. So it's only the financial advisors who are open and have the right business model and fee structure and also I guess have the right business ethics to go, okay, well, it's very hard to borrow money from the banks to buy shares. It's a lot easier to borrow money from the banks to buy property. Yeah. So why would I, as a financial advisor, exclude property, which has made a lot of money for a lot of people over many generations? And there's no indication that that will change into the future. Yet a lot of financial advisors will go, oh, nope, sorry, I don't like it. So that's probably a big red flag for people if they go to see a financial advisor and you ask them about property, what do you think about that? And they go, no, you should probably buy shares. You probably have your answer that they're thinking about their best interest rather than your best interest.
And so typically what you're explaining is that the funds under management, the valuation of a financial advisor in their book means a lot more to them. And the more money that they bring in through managed funds, there is a better valuation and more money that they can make. Is that true?
Yeah, absolutely. It is. Yeah. So most financial advisors will charge about 1% of the money that they advise you on. So if there's $1 million that they look after in a, say, super fund, they'll charge you $10,000 a year on average. And then when the financial advisor gets to the retirement age, they'll want to sell their business. And the financial advisor world, they trade, people buy and sell financial planning businesses, and they generally sell for about 3.5 years of the client revenue. So for that example, if someone's paying $10,000 a year in fees, that person can be sold like a commodity for $35,000. So again, it's in the financial advisor's best interest, to their own interest, maybe not your interest, but the advisor's interest, to get you to put more money into shares and managed funds, because they're getting revenue from you every year, but also they're building their own asset, which is you, which they're going to sell at some stage.
Yeah. And in the property world, if you talk about financial advisors, you don't see a lot of good ones who talk about property, but there is a lot of taboo around them being the insurance salespeople, and they're always flogging insurance products.
Yeah.
So how does that come about into all of these things?
Yeah, it came about because back in the 1980s, in the infancy of the financial services sector, what we call financial advisors were really sales people for insurances. They'd be selling life insurance products and getting really big commissions. And then as we got through to the late 80s and early 90s, we started to introduce savings accounts and superannuation accounts. But again, there were very high entry fees, very high exit fees. They weren't very good products. So I guess the perception from the public is that financial advisors are salespeople, because that's what they've been doing for the past 40 years. But there has been a lot of change over the past 15 years. There's been education standards brought in, which have been raised quite high. There's compliance, ethics. There's all these rules and regulations that make financial advisors today very similar to any other profession, whether it be accounting, legal, mortgage broking.
Yeah. Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book. So from a compliance perspective, they can advise on property. It's not in their best interest. And so if you go down the path of understanding what are the key things, if a person is looking for a financial advisor to advise on some of these things, what are the key things that they should be looking out for?
Yeah, so if you're interested in buying property, for example, as an investment, you should probably start to pepper the financial advisor with questions around their views on property. And so if they start to say, oh, no, I don't like property, don't do that, well, then, yeah, that's probably a sign that that's not the right financial advisor. And then also you want to understand how they charge. So with our fee models, for example, we have different options. So we do have that traditional model where we charge 1% of our clients' wealth that we actively manage because we're trying to outperform the share market average and earn our keep.
Yeah.
But we also have a retainer model as well that suits our clients who either just use us as a sounding board. So they're very self-directed. They might be running their own business, or they might have a family trust, and they might be acquiring properties and businesses. And they just want someone with financial expertise to sort of say, hey, I'm thinking about doing this. What do you reckon? So that can be great for some people. And then the other thing to look out for is whether they have a flat fee structure. So we offer that as well. And that's really good for our property investors because it just takes away any conflict of interest because I'm charging a fee. So financial advisors basically sell their time. We're charging a fee for our time and I can talk to you about property, about shares. And for me as a financial advisor, it makes no difference as to from the commercial side of things as to what I recommend. Putting that aside though, I always have clients' interests at heart. And so there's been many times where I've said buy property rather than shares. And that's meant less revenue for me, but a better situation for the client. So I guess I guess overall, in talking about that, just getting the feel for the personal ethics of that advisor as best as you can. Are they honest? What they recommend for you, is that what they're doing for themselves, for their family? Or are they telling you one thing, but then doing something else for themselves?
Yeah. And it's more preach what you practice, right? That's what it comes down to. I see a lot of people practicing what they're preaching, but don't go around preaching what they practice.
Yep.
It's a very unregulated market when it comes to property advisors. And I'm going to say something out loud that the viewers and listeners and a lot of people are going to hate me for this. But over the last, I would say post-COVID, there has been flood of property advisors, property gurus out there in the market. They're spreading almost like COVID. What is your advice to a lot of these people who are reaching out to so-called property prophets, property gurus, and how do you go around filtering the noise and talking to the right people?
Yeah, it's really difficult because there's a huge variance of the quality of property advisors in my observation over the past 20 years working with various buyer's agents. And you're correct in that the education standards and the standard to become a buyer's agent is relatively low. And I think it should maybe be a little bit higher because it is a very important thing that buyer's agents offer. So in theory, somebody could be working at a retail store and then go through a course and then a couple of months later, bang, they're a buyer's agent. And they really don't have that experience. They don't have the networks, the expertise to be able to really add a lot of value, but they're out there and they're competing with people like yourself who do have all those things. So it's really about grilling the prospective property buyer's agent and understanding, all right, what's been your track record? What have you been buying? How has that gone? Where do you think that the markets are going? What data are you relying on that? Do you have conflicts of interest? Will you get kickbacks from mortgage brokers and other people? And there's other little traps as well around some buyers agents will only sell brand new properties and they'll discourage you from buying an established property. And they'll say, look, because it's depreciation, you get depreciation when you buy a new property, but really it's the up to 10% commission that they're not disclosing to you that they're getting from the developer. That's the driver why they're recommending a brand new property. So it's similar to finding a financial advisor. Finding a property buyer's agent, in my opinion, is about finding someone with like good, strong personal ethics, but also someone who can add value through their expertise and experience in the property sector.
And both of these people, like, I think they play a really big part in when you call about the financial independence journey of a client, right? I always say this out loud to people, that you are playing with someone's future when you're making some of these decisions. And so you need to think about it logically about whether would you do it for yourself. And if the answer is no, you should never do it for a client. And so it comes down to the ethics, but it also comes down to experience that you bring on the table too. So a lot of people have always seen the good side and they've never seen the bad side of property. And so post-COVID, you've seen these massive booms where properties have grown by 30, 50, 60%. And so they think that this is the direction that the property always goes, right? So when the interest rates started rising, you would see, I saw a lot of noise basically cutting out as well, because people panicked and they realized who is the real deal and who are the people who were basically coming out because it was no more rain and sun was shining now. So yeah, I do strongly believe that there needs to be some sort of regulation around this. Becoming a buyer's agent is quite simple, quite easy. But when it comes to property advisory, data models, financial modeling, etc., work very closely with the financial advisor and provide that long-term view to the client so that they can make some of these decisions, which I call it evidence-based decision making, right?
Yeah, no, absolutely. And a financial advisor and a property advisor can work hand in hand, because a financial advisor will take more of a holistic, longer-term view. And part of that strategic roadmap, I guess you could call it, for what we provide to clients is property investment for a lot of the times. So we may say, okay, it may be appropriate to establish a self-managed super fund. You have $600,000 in super. We're going to allocate $300,000 as a deposit towards a property inside of the super fund and get a limited recourse borrowing arrangement and gear up and buy a property for, say, $700,000 in super.
Yeah.
And then we'll work out the cash flow of the super fund and we'll say, okay, well, these are the type of metrics that we'd be hoping for on that property. We want a gross rental yield of 5.5%. We'd be great to get capital growth over a 10-year period that averages 6 or 7% per year. And then we may do a similar thing in their personal situation as well, to say, using the equity in your property, maybe buy an investment property, maybe another one in 3 years' time. And if you do those things, we forecast 10 years down the track, you'll be in a XYZ better position than you are right now, which means that you can retire earlier or retire with more passive income. So that's what the financial advisor will do. But then when it comes to actually acquiring that property, we're not licensed real estate agents. We don't have the research expertise to acquire the property. We may be able to guide around price points and metrics, yield versus growth, that we'd be hoping for. But then that's when the buyer's agent will come in and go, great, and pick up the brief that we provide, and then they'll do the execution side of it and buy that really great property.
Yeah. Talk to me a bit about, and we talked about this at the start, just really brushed off. When we are talking about independent financial advisors versus dependent financial advisors that are working for big banks, how do they differentiate, and how does like some of these big banks chain you down to their own policies?
Yeah, so it's changed a lot in recent years, because after the Royal Commission, a lot of the big banks got out of financial planning. But before that, it was sort of counterintuitive, because, like, for example, I bank at Commonwealth Bank. I had one of those Dolomite accounts as a kid. And so a lot of people think that if I need a financial advisor, I'll go to my bank, because it's a big bank. You have to trust them, right? But what they don't know is that the bank financial advisors are primarily sales driven. They have targets they have to hit. They have to try and achieve a certain amount of sales volume or investment into the bank's products, whether that's insurance products, wealth products, home loan products, debt products.
Yeah.
And so you sometimes don't get the best outcomes. So they're, I guess, not the independent advisors. The true independent advisors are the ones that just charge a pure fee and they don't receive any commissions on insurances. So that's what we call a pure independent advisor. I'm not one of those, because when we do life insurance recommendations for clients, we get an insurance from the insurance company, because I found that people aren't willing to pay thousands of dollars for insurance advice when they can go, okay, well, as long as you don't just preference one insurance company and you look across the market and give me what's best, I don't mind if the insurance company pays you a commission to remunerate you.
Yes.
So we get a fee from the insurance companies on commission, but we don't get any commissions at all from investments. We're not tied to any other institution. So that's sort of like the middle type of, technically by the government, we can't say we're independent, but we can say that we're self-licensed, or we're not aligned to a big group. So I guess you have three different types of advisors.
Yeah, and you're not basically selling their products. You're still quite independent in a way that you're looking at multiple products like a mortgage broker, right? And you're advising the best product that is available out there.
Absolutely, yeah. So when it comes to super, for example, our firm is registered with Australian Super. So we recommend Australian Super accounts to our clients, which is an industry super fund. And that's a thing that a lot of people think, oh, financial advisors don't recommend industry super funds. But we do, well, some of them do. We can also recommend retail super funds, because there's differences between industry and retail super funds. And then we can also recommend self-managed super funds. So within the superannuation space, we can recommend from very simple to very complex, and then apply that to every other part of your financial life. We can do that as well if you're not tied to a big bank or a big financial institution.
Yeah. And I think that's a good segue to talking about general market trends. You talk about super, and I was talking to someone yesterday, and I heard that Vanguard is coming into SMSF space. And God, I love Vanguard. I think their returns are just spoken for. Anyone who's been doing investments for a while, they would know who Vanguard is. How do you feel about that? They have been basically making a lot of noise in that space.
Yeah, no, it's great. More competition, the better, because it means that more people will invest in companies like Vanguard and Beta Shares. It means that these companies can bring the cost of their investments down as well. So there's always going to be a segment of people who are self-directed and self-driven, and they'll say, I like Vanguard because they're an index type investment, and they look at the data which shows that it's less than 10% of fund managers, active fund managers, actually beat the index over a 10-year period. So for the majority of the times, you're actually just better just buying the share market average in a Vanguard type fund. So a lot of people go, I just want something simple, buy a couple of ETFs through Vanguard, and that will suit me. So I think it's great to have these options available for those self-directed type clients. But then other people who want to be a little bit more targeted with the way that they invest, we build portfolios for them. So we take 10-year views around things such as like uranium, electric vehicles, those type of themes, and then we build portfolios accordingly. So we're trying to outperform the market by being a little bit more tactical and being a little bit more reactive to changes. Things like the US election, that has big impacts on share markets, whereas the Vanguard fund will just continue to hold the same type of investments, whether that's wrong or right. So there's horses for courses.
So I've been saying this out previously as well, that while the tail boom of the mining is about to finish in 25, 26, with these news coming through now, the impact on the raw materials that Australia provides to China would be even less. The demand would basically be captured and tapered off as well. So how does that plays into all of this, especially single dependent economies in Perth, which are FIFO dependent or mining dependent? People who have been treating properties as penny stock, they need to think about this very, very carefully and come out of some of these stocks, or come out of some of these asset classes in 25, 26 to making sure that they don't make the same mistake that 2015 made, where the market just dropped like a penny.
Yeah, that's interesting. So are you saying that you think there's higher risk in places like Western Australia over the next couple of years, given the strong growth that they've had, and maybe people should start to think about it and review the portfolios?
And there are places in Western Australia where people have gone in and bought a lot of properties chasing yields because of the higher interest rates. And so while from a short-term growth perspective, they might have done quite well, it's always about the demand and supply as well. You need to understand when to come out of some of these markets as well, exactly like share markets, right? And because people are, like humans are greedy, they try to just stick around for as long as possible while they're reaping the benefits. And so my view of the world is, okay, we've been following the demand and the supply trend for quite long, and that's fine. And if you want to play that sport, that's okay too. But know when to come out. Don't wait for that pinnacle to happen. Just come out beforehand so that you're not like the other sufferers when the market basically tanks.
Yeah, no, that's a really interesting point. And that's probably a good characteristic of a buyer's agent as well, is that they help you buy, but they also help you sell as well, because some buyer's agents, they're all about the transaction. They want you to buy as soon as possible because they get their commission. And then once they've done that, you never hear from them again. But as a property investor, as you're saying, we need to know when to buy, but also when to sell as well, because properties generally go through cycles up and down. So a good buyer's agent, I know that you do this for your clients, and your group does this. You're in regular contact with your clients to review their portfolio have a look, should we cash in our chips and move over to this other area, thinking about all of the issues with interest rates and their cash flow and capital gains tax and all those type of issues. And I don't want to hijack what you should be asking me the questions, but one question I had was around how do you talk with clients around cash flows of properties? Because interest rates today, so an investment loan rate maybe say 6.5% or 7%, but in 3 or 4 years' time, it's probably going to come down to like 5.5%, something like that. Yeah. So when you're looking at cash flows on properties and you're looking at the debt funding side of things, do you work on the current interest rate, even though that'll come down over the next few years, or do you work on more of a normalized long term?
It's always normalized. So even like 3 years ago, when the rates were at 2% from a bank rate perspective, we were still assessing portfolios at 5%. And people used to complain to me. I still remember clients complaining to me saying, why are you taking 5%? And I was like, well, if you're saving money and your cash flow is better, that's great. Use that money to pay down your debt. Perfect, right? But times like now where the rates are higher and our long-term rate is lower and you have that disconnect of 1.5%, you have built that buffer over the last 3 years for you to ride this wave, right? So we always take a long-term view. Our rates from a modeling perspective always sits at around 5%. And that's how we basically navigate these conversations from a client's perspective, that it's all about making sure that you ride the volatility rather than responding to where the rate is right now. And so both of the views are wrong, where where the rates right now at 6.5% and people are trying to hit 8, 9, 10% yield. I say, well, this is a point in time decision. You shouldn't be making point in time decision. And same with when the rates were at 2% when people were buying properties at 3% yield, calling it positive cash flow. Both of those extremes are wrong. You need to basically think about it from a long-term perspective.
Yeah, no, absolutely agree. And we do the same in our projections. We assume a normalized long-term rate. And I guess one thing that comes to mind that financial advisors do is that we do stress testing as 100%. Well. And so we look at, well, what if you lost your job, or what if interest rates went up by 2%? Can you still afford this property? Because it's all great and well to buy property and build wealth that way, but we need to think about what could go wrong and make sure that we have provisions there for that, so that we're not leading people into financially irresponsible decisions around property, because people can get caught up in the glitz and glamour of property. But at the end of the day, it's a risky thing to do. You're borrowing the bank's money for the majority of people. They're borrowing a lot of the bank's money, buying an asset. That asset sometimes has negative cash flow. So the only way that you make money on a net basis is the property grows in value. And if you're not getting that, you're actually going backwards.
Definitely.
So, yeah.
And I see that all the time. I was talking to a client about 3-4 weeks ago where the bank had approved them a loan of about $700,000 or $800,000. But when I started having the conversation, asking them how much do they save, they said $500 a month. And I was like, well, geez, you can't afford a property. And they're like, but the bank is giving me this loan. I was like, well, I don't care what the bank says. Like, you can't buy a property till you fix your finances, right? And so they were earning a lot of money, but the financial discipline was not there for them to go into buying this property. And so there is this big problem of, yes, the love of property is there, but people fall into this fallacy that you need to have a financial discipline in place. You need to have that sort of rigor in your mind. No one is asking you to live frugally on baked beans and spaghetti, right? But you need to have some sort of mentality and mindset about where is your money going? Why is it going there? It's an intentional decision for you to basically send it there. And if the need be, you can bring that money back to support your lifestyle, right? So yeah.
Yep, no, that's absolutely right. And another thing which we commonly discuss with people is rent versus buy for your own place.
Yeah.
And so we have a look at basically the opportunity cost. So if you're renting, a lot of people say it's dead money, but a lot of the times it can be cheaper to rent where you want to live rather than buy a property in that same area and have to buy for a very high price and pay a lot of interest to the bank. 100%. But then on the other hand, you have those lifestyle benefits of buying your home, the put the nail in the wall to put the painting up type thing, and the long-term security of not being kicked out by a landlord. So there are a lot of lifestyle benefits of buying a property, and you do get the capital growth as well if you've bought the property. So we discuss those type of issues with clients, and there's no one right answer. It's what's appropriate for you once we just take into all of the financial and the lifestyle considerations of rent versus buy.
Yeah. And I think you make a fair point. When you think about property investing, people think about property on its own as an independent vehicle. And I say that can't be the case. Life happens and the life needs to respond to with the property investing in it, right? So it cannot be go buy a negatively geared property and cross your fingers and wait for this property to grow up. You need to make sure that you're building a portfolio in such a way that it's sustainable, it's scalable, it responds to your own lifestyle as well. You're getting married, you're having kids, you're moving overseas, you're changing your life, you're losing job, right? So all of this needs to be considered. So thank you for sharing some of this. Where do people find you, James?
They can go to our website, financialadvisor.com.au, and all of our contact details are there.
Perfect. Any golden words before we wrap this off?
I would say, relating to property, my general advice is buy sooner rather than later. I see people who they want to save that extra bigger deposit so they don't have such a big mortgage, but they end up chasing their tails because their ability to save is quite hard. It's expensive in Australia. Most capital cities, rents are high, cost of living is high. So they may not be saving enough each year to try and build that bigger deposit. And over the last 40, 50 years, property markets in Sydney and Melbourne have grown by, like 7-ish% per year, but wages growth is maybe 3 or 4%. So they get further and further behind. So my broad advice is that buy a property sooner rather than later to get on the ladder, so you're not sort of left behind and missing out on the growth that other people are getting.
100%. Thank you for coming out today, James. And for viewers and listeners, if you have any questions, if you have any stories to share in relation to the financial advice or financial advisors, good or bad, please jump on our socials and share those stories. If you have any questions for James, you can always reach out to us at info@helpmebuy.com.au. Thank you for listening to us today. Take care, stay safe, keep smiling, keep investing. This is Moss and James checking out. Adios.